be here. Participated at previous COFAS conferences, all wonderful. And after having given such a comprehensive view of China, which starts, we're positive, but we wonder whether it is so positive, but I kind of agree. You know, it's hard to see a lot of positive news around, except for the stimulus. And I start, in a way, my line of thought will actually follow very much what Haibin said. But I've been asked to talk about corporate health, and I'll focus on that basically. So I'll bring the macro only as an input for that. And I realized that I should have finished by now, so yeah, I'll be pretty quick. And to do so, I start with the key points, and then, you know, if I can't get any further, Pauline list the minute thing, and I'll stop. But you can always see the presentation, which is much longer than it should have been for a 15-minute talk. So I'll start with this question, deleverage. We heard about deleverage. I mean, if we talk about financial deleverage, we could discuss that. I will have my views, and I'm sure Andrew has his later. I'm talking about real deleverage. And there's no such thing as real deleverage in China. And there hasn't been even before China's door was knocked at by the US. And this is about corporates. I would extend to households. I would go further. We saw the augmented fiscal deficit that Haibin showed of about 10 to 12%, not even on the government side. So there's no deleverage that I care for, because I care for real deleverage. That's the deleverage we should be looking at. So that's the first thing. Second is no expectation of any deleverage in 2018, if not the opposite. Because, again, what are you going to do? You're going to stimulate the economy. That's going to make it easier to borrow rather than harder to borrow. And if anything, you know, this only brings further risk to the corporate world, not everywhere though. So I like to talk a little bit about good sectors versus bad sectors. Yeah, so I basically said everything I have to say. These good sectors, if I manage to get there, are basically health, care, and utilities, the least leveraged sectors in China, and the least affected, actually, if you think about it, by what's happening. So you want non-tradable sectors that are not leveraged. That's what you want in China today. There's a non-tradable sector that could look wonderful as it is non-tradable, but it's awful, and that's the real estate sector. And it so happens that it's, as Haibin reminded us, 20 to 25% of investment in China, plus if you add infra, about 50. That's what it is. So think about a concrete economy, basically. So you want to know a little bit more about corporate health in China. We have a report that is published only annually, which looks at the 3,000 listed corporates in China. We compare them to the rest of the world because this is basically the idea of asset managers trying to overweight, underweight sectors in China or elsewhere. And we organize this as new economy, old economy. So the gray are old economy China sectors. So what do we find when we do this analysis of these 3,000 listed corporates? That China's corporate world, that is a listed corporate world, continues to leverage. So we're talking about something of the close to 200 already total liabilities to equity. And if you look at the light blue line there, the rest of the world, these 3,000 comparable companies, or at least, I'm not sure how comparable, but listed companies of the same order are deleveraging. Now, you would be tempted to think about this is because it's easy for SOEs to leverage, and, you know, these are the ones playing the game. No, it's the private sector. But if I happen to dwell into who is behind this private sector, I find this massive blotted real estate sector, not the rest. There's wonderful private companies in China. They don't happen to be generally in that specific sector. And I'll talk about it if I have time later. I'll try to be brief. If you think about something more comprehensive, and Haibin mentioned that 2017 in a way was a great year. You may say, what? How come it was a great year for corporates? Very easy. because the revenue stream increased so much. Think about what happened to producer prices. Even more so in the sectors where there was overcapacity, prices of iron ore, etc., were increasing dramatically. So that helped the revenue stream of many of these sectors. But not enough to have an EBITDA to interest expense comparable to the rest of the world. That's what I'm trying to say. It improved a bit, but not enough. And if I were to show that for a number of massive real estate companies, some of which listed in Hong Kong, you would want to see that. And I'm not going to show it to you, but we do have the figures. You can even calculate it yourself. It's pretty scary. There is no ability to repay. And by the way, again, SO is better than private sector. Number of zombie companies, we talked about zombie companies, we forgot about zombie companies because of the good times in 2016-17. But I want to remind you that no matter what we heard about zombie companies in Europe, still average much lower than China. So if I define zombie companies as EBITDA to interest expense below 1, which is kind of, you barely pay your interest, it's still about 10% of listed companies in China, as opposed to 4% globally. So if you tell me which are the sectors, it's very hard to read and realize. It has all of the inputs that we've used to classify sectors in China as better or worse. Healthcare, utilities, by far the best, and this is a combination of leverage, repayment ability, revenue stream, quality of investment, you name it. Worst is by far the real estate, followed by infrastructure, 50% of China's fixed asset investment. Now, is it going to get any better? Are they going to deleverage? Why would you deleverage now? You need that growth more than ever. And that's kind of the key message I want to. And by the way, the government is going to help you. I realize that, and I agree with Haibin that it might not be so easy to push lending as it was, because this is all about the return on assets being so much lower when you lend. But it's all about do lend, do issue. We already heard, do issue 2 trillion. That's what I'm going to show you in a minute. I mean, come up with something, basically. Haibin also showed the fact that the tax revenue was not following. Of course it's not following, which is great news for growth, because they've already introduced massive cuts in corporate tax, individual tax. Of the other of 1.1, my analyst told me already 1.3, Alicia, I couldn't change that on time, meaning much larger than this well-known US corporate tax. So that's where China is heading, and frankly, rightly so. If I think of 1 percentage point in cutting my growth forecast for next year, I will be doing that and more. Because the reasons, by the way, are pretty scary. It's not just, I don't know, a typhoon. It's really something that is coming after you. So, of course, China is stimulating through fiscal. The other thing I'm showing is just, please do issue more bonds. So yeah, TSF is, but wait for the massive bond issuance, in my opinion, that is going to happen onshore. Onshore and managed cheaper. And it is so much cheaper. Look at China rates, SHIBOR, say 3 months. It's lower than, it's like 2.7. It's very low. It's coming from much higher levels. Stable for the 10-year. So if you think about where the US is heading, this is basically massive monetary policy divergence and financial conditions divergence, i.e. 10-year. It's not only about the short end. The whole thing is divergent. So it's cheaper. And this is to create growth. And why would you want to create so much growth? Because this is what's happening. This is the proportion of overseas revenue by Chinese corporates. It's only growing. We tend to think that China is less dependent on exports, which is what everybody shows. China's exports have share of GDP falling. We know that. We keep on seeing this graph. We don't seem to be seeing this one, that actually overseas revenues are increasing. and that there are a few sectors out there, such as the ICT sector, for example, that are heavily dependent on overseas revenues. Yeah, I'm sure I'll make it in 5 minutes, thank you. 26%, only growing in the case of consumer durables, for example. So this is, of course, not only the US. This is all of the overseas revenues, I need to clarify, but this is quite a lot. And if you think about sectors where, yes, I acknowledge that China has not yet imposed tariffs on semiconductors, rightly so. It imports more semiconductors than oil. Why would you tax something that you need so desperately? Still, I think that you can think of the additional cost, yeah, in China's value chain of eventually, for whatever reason, and eventually maybe tax as well. Because what can you do if they come up with a full blanket import tax for all of your exports? So you can think of also costs. I'm not going to talk about inflation, but which in a way is good for corporates because it could help their profit margin. But this time is all about inputs of production from the rest of the world, so it's very important. Anyway, long story short, I am going to skip the whole semiconductor thing, and happy to take questions if somebody's interested. I just want to show that, yeah, China's corporate debt is if not increasing, stable, and is due to increase. So I don't think we can, again, from the beginning of my presentation, talk about reality leverage in China. You see those figures there, and I'm going to move now to the elephant in the room, which is the real estate sector. So if you followed me, which is hard because I know I was very quick, you may remember a figure of something of 186 total liabilities to equity for China's corporate world. Look at that one, 400, over 400, for 466 for the real estate sector. We're talking about more than double. The rest of the world, even less than global average. So it's such a huge difference. It's such a bloated and indebted sector. And by the way, it's a sector that has happened to be hanging around in Hong Kong issuing. Yeah, we've all seen them because it was cheap. We ran a report which is kind of for clients, for issuers, comparing the cost of funding in onshore, offshore, and the cost of funding offshore until the Fed kind of woke up to reality was so low in 2016 as opposed to a very tight monetary policy in China that everybody was coming. Even for the real estate sector, it was cheap to issue here last year. It's over. You need to pay all the way to 9% today to issue here in dollar. You're a real estate developer. So I'm saying there's no respite from the offshore market as there used to be for these very highly leveraged real estate developers. So to me, this is where the risk is. I'm going to conclude by saying that no matter the improvement in revenue, which I acknowledge in China's corporate world, a lot of that improvement, there was a little bit of volume, a lot was value, because there was a lot of price catch-up on the wholesale price world, but there was no such thing as, okay, now that I'm doing relatively well, I'm going to deleverage. There wasn't such a thing. I could talk about some sectors where that happened, but they not on average, and certainly not on the most leveraged sector, which is the real estate sector. Prospects for 2018, in a way, good prospects if you think you don't need to change your model because they're going to be cheaper. Because they're going to do additional stimulus, right, answering to the US threat, if I may say, rightly so, what can you do? But it's not going to help the leverage. And that is all fine for some sectors because they're not very leveraged, say the ICT sector, or I mentioned utility sector, etc. But still they will have the threat of the US trade war in their tradable sectors, ICT in particular. So it's hard. I mean, the share of good sectors is kind of narrowing. That's what I wanted to say. Yeah, to those that are non-tradable, so affected, and not leveraged. That's what you have. And yes, and I would certainly call for caution for this massive sector, which is the real estate sector in China. Because the cost of funding, no matter how you push it, if anything is going to increase your problem, which is leverage. And I wonder whether in China's current circumstances, their revenue stream will continue to do as well. A lot of that was actually front-loading their orders, by the way. That looks very, very scary to me. So I leave it there. Thank you very much for your time.